Ready to embark on your financial journey? Discover the secrets of investing for beginners and learn how to earn a remarkable $17,000 plus per week through the world of stocks. When it comes to making money through investing in stocks, you must tackle the pesky issue of inflation right away. Over the last 6 decades, it's been chugging along at an average rate of 3.8% per year. If your money isn't growing faster than that, you're essentially losing out over time. Ideally, we'd all have savings accounts that magically return 8 to 10% annually, beating inflation and making us some profit. Sadly, such dreamy savings accounts don't exist in reality. But here's the exciting part. You can achieve those returns by diving into the stock market. When you buy a stock, you own a tiny piece of a company, making you a shareholder. As a shareholder, you have 2 potential money-making avenues. First, if the stock's price goes up while you hold it, you can sell it for more than you paid. That's capital gains in action. Secondly, some stocks pay out dividends, which are regular shareholder payments. If your stock is a dividend payer, you can receive cash without selling your shares. Now let's talk about the real game changer here, compound interest. Imagine you own a bunch of stocks that grow by an average of 10% annually. The magic of compound interest kicks in and your wealth starts snowballing. This means that the longer you hold your investments, the more powerful your return becomes. For instance, if you were to invest $250 every month with an 8% annual return, in just 42 years, you'd hit the Millionaire Club. And if you keep going for another 10 years, you'd have more than $2 million in your account. Remember, this is based on historical data and isn't guaranteed, but it's a powerful principle. So, what's the secret sauce to this millionaire recipe? Time. That's why the next question is crucial. When should you start investing? Start as early as you can. Why? Because time is your greatest ally in the world of investments. When you begin early, your money has more time to grow and benefit from the magic of compounding. Starting young also allows you to take on more risk. Even if there's a stock market downturn, which is inevitable, you have time on your side to recover and thrive in the long run. However, life often throws hurdles in your path before you can invest. So here's a practical approach. Clear high-interest debt and build an emergency fund. Before investing, ensure you've paid off any high-interest debt, like credit card balances. Aiming for a 10% return in the stock market doesn't make sense when you're paying 15% to a credit card company. Next, build an emergency fund covering 3 to 6 months of living expenses. This cushion ensures you won't be forced to sell your investments in case of unexpected emergencies, which can disrupt your financial progress. Once these steps are checked off, you're in an excellent position to start investing. If you're under 18, consider asking a parent to open a custodial account, which can provide you with a significant advantage in the long run. How much to invest? Finding your comfort zone. Now you might wonder, how much should I invest? While some people advise going all in, finding a balance that suits your life and goals is essential. Consider the 70-20-10 rule. Allocate 70% of your income to cover living expenses, earmark 20% for investments, and reserve 10% for enjoying life. This approach allows you to build wealth while still enjoying the present. Remember, investing isn't just about making money, it's about securing your financial future and enjoying life. Getting started. How to buy stocks. So, you're ready to dive into investing and wonder, how do you buy a stock? It's simpler than you might think. Here's a straightforward guide to help you get started. Choose the right investment app. An array of investment apps is available that make buying stocks a breeze. Look for one that suits your needs and financial goals. These apps often offer user-friendly interfaces and valuable resources to help you make informed decisions. Open the right account. Before you start investing, ensure you have the appropriate type of account. In the USA, you might hear about Roth IRAs. In the UK, it's stocks and shares ISAs. Canada has TFSAs, and Australia boasts supers. These special accounts have tax benefits, allowing you to keep more earnings. However, they do have contribution limits, so be aware of them. Embrace fractional shares. One fantastic feature many investment apps offer is the ability to buy fractional shares. You can invest even small amounts, like just $1, rather than purchasing whole shares. It's an excellent way to gain experience without taking significant risks, especially if you're starting. A top pick, Trading 212. One highly regarded investment platform is Trading 212, which offers fractional shares and tax-efficient accounts. It's a user-friendly platform with a unique feature: practice investing with virtual money. This allows you to familiarize yourself with real market data without risking your hard-earned cash. As a special offer, Trading 212 provides free stock worth up to $100 when you create an account using the code Tilbury. This is a great incentive to kickstart your investment journey. Choosing the right stocks, a simple approach. When it comes to picking the best stocks, simplicity often reigns supreme. Our investor, let's call them Alex, believes in straightforward strategies that have helped them succeed. Here's a simplified take on how to select winning stocks. Understanding stock market analysis. Two primary methods for predicting the stock market are technical and fundamental analysis. Think of it as a scale. Short-term traders usually focus on technical analysis involving charts and patterns to predict price movements. On the other hand, long-term investors like Alex keep it simple by emphasizing fundamental analysis. This involves examining a company's financials, leadership, and brand recognition to gauge its long-term success. Alex's investment philosophy centers on holding stocks for at least 2 to 5 years, so timing the market isn't a priority. However, they occasionally consult charts to identify optimal buying opportunities. This balanced approach has helped Alex make profitable investments over the years. The power of index funds. For most people, index funds are the go-to investment choice. These funds mirror the performance of an entire market or specific sectors, offering a simple and diversified way to invest. Alex allocates a significant portion of their portfolio to index funds due to their many advantages. The S&P 500 Index tracks 500 of the largest US public companies. Alex favors funds like VFIAX and VU ETF for US investors and VUSA ETF for UK investors. Despite some tech dominance, this index has historically delivered 8 to 10% annual returns thanks to compound interest. Total Stock Market Index. This index represents a broader spectrum of stocks, offering diversification across the market. Alex trusts VT-SAX Index Fund, VTI ETF in the USA, and VWRL ETF in the UK. While it depends on overall market performance, it's ideal for long-term investors who prefer a set-and-forget strategy. Emerging Markets Index. Alex believes in including emerging markets in their portfolio. Emerging economies such as China show significant growth potential. VEIEX ETF in the USA and VFEM ETF in the UK are their preferred options, while riskier emerging market funds provide diversification beyond developed markets. Is investing risky? Investing inherently carries risks, but how you define and manage them matters. Not investing also poses financial risks, as inflation erodes the value of your money over time. Alex suggests a diversified portfolio to mitigate risk and gradually add bonds, especially as retirement approaches. For young investors, not taking enough risk can be a more significant concern than market volatility. Historical data shows that a diversified portfolio held through market crashes tends to recover and grow over time. When to sell stocks? Alex's advice is clear. Hold stocks for as long as possible to maximize growth. Selling stocks should ideally happen under these circumstances. 1. Emergency. Your investments can be a safety net if you encounter an unexpected financial crisis, but remember, having an emergency fund is the first line of defense. 2. Underperforming stocks. If individual stocks consistently underperform, consider selling them to minimize losses. Assess the industry as a whole before making a decision. 3. Goal achievement. Setting a target price can be useful for short or medium-term goals. Once the stock hits the price and you've met your objective, it might be time to sell. In Alex's view, the longer you hold your investments, the more time they have to grow. Avoid panic selling and let your investments compound over time. In conclusion, investing can be simple. It's a simple yet effective strategy for building wealth over time. Remember, investing is a marathon, not a sprint. Thanks for tuning in. We'd love to hear from you. What's your favorite investment strategy? Share your thoughts in the comments below, and don't forget to subscribe, hit the bell icon, like and share for more financial insights.